Major shakeup in the US stock market. Key events to watch this week. The Suspense Unveiled. The world's attention is now focused on the latest moves and statements from the Federal Reserve. Currently, the central concern in the market is whether the Fed will maintain high interest rates or gradually shift towards a more dovish stance. The decline in inflation data and the cooling of the job market have provided reasons for expectations of rate cuts. But geopolitical uncertainties and potential risks to economic growth have made the policy path uncertain. Investors are trying to catch any hint of future policy direction from the Fed chairman's every word. Friends, I'm Chinking with 5 years of experience in the U.S. stock market, breaking down money-making knowledge and making financial insights simpler. This month, the Fed is very likely to cut rates again. And the only thing left to wait for is Chairman Powell's green light. In last Friday's FOMC meeting, Powell sent a clear dovish signal in his highly anticipated speech, which triggered the biggest cross-market rally since April. Previously, Powell stated, "A shift in the balance of risks may require us to adjust our policy stance." This comment immediately ignited market sentiment. The Goldman Sachs index rebounded strongly from its previous 5-day losing streak, rising 1.5%, marking the largest gain since May and closing just below its historical peak. The Dow Jones Industrial Average reached a new all-time high. Meanwhile, interest rate and economically sensitive stocks drove the Russell 2000 index up nearly 4%. The U.S. dollar index fell back, and the cryptocurrency market surged across the board. Ethereum hit its highest price in nearly 4 years, and gold rose by 1%. Amid the excitement, new uncertainties have emerged. The first uncertainty, even if a rate cut in September happens, the future policy path remains highly uncertain. The market must not underestimate the possibility of the Fed cutting once and stopping. Some more aggressive market voices are even betting that the Fed will implement a 50 basis point rate cut, which usually only occurs in emergency situations. The market may continue to push expectations of a larger rate cut next week. Investors must be cautious at this stage and avoid getting too ahead of themselves. Moreover, a 25 basis point rate cut wouldn't solve Trump's immediate concerns. After Powell's speech, Trump was still dissatisfied and continued to criticize him as Mr. Too late. In my view, although Powell's speech was clearly dovish, his wording also sent a clear signal. A 25 basis point rate cut is reasonable. But a 50 basis point cut would be excessive if the Fed really took such an aggressive step. The market might interpret it as political pressure interference rather than a decision based on economic data. Considering the internal divisions within the committee and the dual risks of policy, the most prudent choice remains a gradual rate cut. In other words, the September meeting will most likely cut rates once first. Then wait and see, with future actions heavily reliant on economic data. For U.S. stocks, a single rate cut may be imminent, but the path of further easing will not be smooth. And the uncertainty surrounding the policy outlook has become the new focal point. The second uncertainty comes from the important data to be released next week, the U.S. Core PCE Price Index. Currently, there are signs that inflation in the U.S. service sector is accelerating, and the impact of tariffs is gradually becoming evident. The PCE Price Index for June rose 2.6% year, higher than the expected 2.5%, with the previous value revised up to 2.3%. On a month-to-month basis, it increased by 0.3%, in line with market expectations. Whether inflation will rise again stubbornly will directly determine the space for future Fed policy. If you want to continue tracking the Fed's policies, U.S. stock market trends, and the latest opportunities in cryptocurrency and commodities, remember to subscribe to the channel. At the same time, U.S. consumer spending is showing signs of fatigue. Inflation-adjusted real personal consumption expenditure grew by only 0.1% in June, in line with market expectations, but it did not reverse the decline of the previous month. Amid factors such as M2 money supply returning to a 5% peak and the Producer Price Index PPI rising to high levels, market concerns about a second wave of inflation are intensifying. Economists warn that the current situation is eerily similar to the Fed's premature rate cuts in the 1970s, which led to recurring inflation, thus makes the Fed's cautious stance particularly crucial. Several Wall Street institutions believe that the impact of tariffs on consumer prices will be slower and more persistent than the market expected. August to September will be a key window to verify this trend. According to forecasts, the PCE price index may rise to 3.2% by the fourth quarter of 2025. Well, however, investors need not worry excessively. Powell has already hinted in his latest speech that the Fed may not wait for inflation to fully return to the target level before cutting rates. This statement may diminish the importance of next week's US PCE data. However, if the data comes in significantly better than expected, the market's reaction could be very different. If stronger than expected, it could shake the dovish camp within the Fed. If weaker than expected, it could push the market to bet on a large rate cut or even multiple rate cuts. In this context, investors will pay more attention to the weekly initial jobless claims. At this point, the weakness in the labor market seems to have surpassed inflation risks, becoming the main consideration for Fed policy. The market's reaction clearly reflects this shift. Another key data point is the U.S. second quarter real GDP. Last month's data showed that U.S. GDP, excluding inflation, grew by 3.3% annualized in the second quarter, reversing the contraction in the first quarter and significantly surpassing the market expectation of 2.6%. However, a deeper analysis reveals that the sharp decline in imports artificially raised the overall figure, masking the reality of domestic demand slowing down. UBS, in its research report, forecasts that U.S. GDP growth will slow sharply from 2% in the second quarter to 0.9% in the fourth quarter, significantly below the market consensus expectation of 1%. The reasons include consumption demand being overdrawn before tariff hikes, excess savings being almost exhausted, slowed immigration, small fiscal drag from infrastructure investment and employment bills in 2025, and rising effective interest rates due to debt extensions. However, UBS also points out some favorable factors. The stock market's 10% rise could add 0.6% to 1% to GDP through the wealth effect. Investments promised by the Middle East, South Korea, Japan, and the EU in recent tariff negotiations are equivalent to 5% of GDP over the next 3 years. The question is whether these investments will actually materialize, and whether a further 10% rise in the stock market from its historical high will become increasingly difficult. Moreover, next week the market will also see another key indicator, the July durable goods orders preliminary data. This data will provide further directional signals for the U.S. economy. Last month, USJUNE durable goods orders fell sharply by 9.3% month. Although the decline was slightly better than market expectations, it was still the worst performance since the pandemic in 2020. This dramatic fluctuation was mainly due to a large adjustment in non-defense aircraft. Orders from a month-on-month surge of 230% in May to a 50% decline in June. However, excluding Boeing orders, the core data is relatively stable. Durable goods orders increased by 0.25% month, better than the market expectation of 0.1%, and grew by 2.23% year. In the first half of this year, business planners faced dual challenges on the policy front. On one hand, frequent changes in on the other, increasing uncertainty regarding tax and expenditure legislation. This environment has significantly suppressed businesses' willingness to invest. Speaking of tariffs, Canada's stance has shifted significantly. Prime Minister Carney stated that Canada would shift from a rapid counterattack on U.S. trade protectionism to a more flexible negotiation strategy. The specific approach is to remove several retaliatory tariffs on U.S. goods. Many commentators believe that Canada's move is to create conditions for the upcoming review of the U.S.-Canada trade agreement. Carney emphasized that future negotiations would focus on strategic areas and revising the U.S.-Canada trade deal. In response, the White House quickly stated, "This is something Canada should have done long ago." Trump publicly commented, "I really like Carney. I think he's a good guy. He's removing retaliatory tariffs, which is great. We'll talk again soon." However, Carney's actions have also been criticized by the opposition party. His former election rival, who lost the election, accused him of saying he was tough on the U.S. before the election, but now he's constantly compromising after it. He has abandoned the core stance of the Liberal Party's campaign, which will only bring more pressure from Trump. But the reality is that Carney has limited bargaining chips, and some concessions may be a necessary compromise. At the same time, next week, the 50% tariff rate on U.S. imports from India will officially take effect. According to an executive order signed by Trump earlier this month, the USWILL imposed an additional 25% tariff on shoe products from India, due to India's direct or indirect imports of Russian oil. With the previous tariffs, the total tariff rate will reach 50%. The new tariff measures will take effect 21 days after the executive order was published, which means that from August 7th, India's shume products will be subject to a total tariff rate of 50%. This will undoubtedly deal a heavy blow to Indian businesses. The latest forecast shows that Indian companies are facing the most severe profit downgrade expectations in Asia. Multiple institutions have sharply reduced their earnings forecasts for Indian companies, highlighting the impact of the trade tensions on this third-largest economy in Asia. Friends, do you think Canada's flexible turn is pragmatic? Will the high tariff on India further disrupt global markets? Feel free to share your thoughts in the comments section. If you found today's analysis helpful, don't forget to hit the like button. Subscribe to the channel and turn on the notification bell so you won't miss our latest market insights. Over the past 2 weeks, the earnings forecasts for medium and large Indian companies over the next 12 months have been revised down by 1.2%, marking the largest decline in the Asian markets. According to the latest Bank of America Fund Manager survey, the Indian stock market has experienced a dramatic reversal in just 2 months, shifting from being the most popular market in Asia to the least favored one. Although India's economy is primarily driven by domestic demand, with only 9% of the revenue from the LIF 50 index constituent companies coming from the U.S. market, tariff threats still pose a significant risk to its growth. In response to this challenge, according to reports from Wall Street, Indian Prime Minister Modi is pushing for a goods and services tax (GST) reform. The plan is to simplify the current 4-tier tax rate structure: 5%, 12% to 18% and 28% into 2 rates, 5% and 18%. Economists expect this tax reform to contribute an additional 0.35 to 0.45 percentage points to India's GDP growth in the fiscal year 2027. Meanwhile, anti-American sentiment is rising in India. U.S. brands such as McDonald's, Coca-Cola, and Apple have become targets of boycotts. For example, India is the largest user market for WhatsApp. Domino's Pizza has more stores in India than any other country. Pepsi and Coca-Cola nearly monopolize store shelves, yet when Apple opens new retail stores or Starbucks offers discounts, consumers still line up. Even on August 11th, when Tesla opened its second showroom in New Delhi, both Indian Ministry of Commerce officials and US MBA's SY representatives attended the event. In other words, while there is verbal resistance, the reality is that U.S. product sales have not been noticeably impacted so far. On the geopolitical front, India seems to be sending some signals of closer ties with Beijing. Wang Yi recently visited India for 2 days, attending the 24th meeting of the Special Representatives on the China-India border issue and discussing bilateral cooperation with the Indian side. This is also seen as paving the way for Modi's trip to China at the end of the month. However, overall, the two sides lack mutual trust, and Beijing has only made verbal statements. On the other hand, Trump has not completely closed the door to dialogue. The 6th round of U.S.-India trade talks, originally scheduled for August 25th, will proceed as planned, with the U.S. trade delegation arriving in New Delhi as scheduled. Of course, next week, the most anticipated event for investors is NVIDIA's earnings report. The company will release its latest financial results after the market closes on Wednesday. The market almost unanimously expects the results to exceed expectations. But the problem is that investor demands are extremely high. In particular, the third quarter guidance will be the market's main focus. According to the latest institutional reports, NVIDIA may temporarily exclude direct revenue from the Chinese market in its next quarterly guidance, due to uncertainties surrounding the approval time for semiconductor export licenses under U.S. export restrictions. A more detailed analysis of this will be covered in a subsequent video. Alright, that's all for this video. If you found the content helpful, please give a thumbs up. Subscribe to the channel and let me know your thoughts on NVIDIA in the comments section. Your support is the greatest motivation for me to continue creating. The stock market has risks, and investment should be done cautiously. Wishing everyone a successful investment week ahead, and I'll see you next time.